Have you ever wondered why some businesses explode with success while others crumble overnight?
The secret lies in one powerful document, the balance sheet.
If you read a balance sheet before investing in any company, then you can spot financial strengths, detect hidden red flags, and even outsmart the market. In the next few minutes, I shall break down how to analyze a balance sheet like a pro investor without any jargon, just skills that investors, CEO, and smart money use every day. So let's dive in. The balance sheet of a company is based upon a simple equation: assets equal to liabilities plus equity. If you think about this, the meaning of this equation is quite simple. All the assets in the balance sheet are financed from the money collected from liabilities and equities section in the balance sheet. This formula always has to be balanced. That's why this financial statement is known as a balance sheet. The liabilities side of the balance sheet helps us in understanding the company's debt and obligations. The liabilities side of the balance sheet is broken down into two parts: current liabilities and non-current liabilities. Current liabilities are those obligations that become due within 1 year, whereas non-current liabilities are those business obligations which become due after 1 year. A thorough understanding of these liabilities is essential to understand a company's financial health and its short-term and long-term obligations. Now, coming to the liabilities side of the balance sheet, the first item that we must look at closely is the retained earnings, which is a part of the book value or the net worth of the company. The retained earnings figure, if you are unable to find it in the asset side of the balance sheet, then you can go to the schedules to the balance sheet and you can find it under the net worth or the book value section. Retained earnings आपका कंपनी हर साल एक प्रॉफिट करती है, उस प्रॉफिट में से एक परसेंटेज वो अपने बिजनेस में लगाती है, तो उसे ही हम रिटेन अर्निंग्स बोलते हैं. तो ये अमाउंट जनरली ईयर आफ्टर ईयर बढ़ते रहना चाहिए. कंपनी अगर अपने रिटेन अर्निंग्स में लार्ज अमाउंट ऑफ कैश एवरी ईयर आफ्टर ईयर ऐड करती है, तो उसका मतलब ये है कि कंपनी
अपने फ्यूचर प्रोस्पेक्ट्स को लेके बहुत पॉजिटिव है और ऐसी कंपनियों का जनरली ग्रोथ पोटेंशियल अच्छा होता है.
Debt on the balance sheet is the money borrowed by a company that's needed to be paid back within a specific period of time. It could be short-term debt which are needed to be paid back within 1 year. This short-term debt is shown under the current liabilities section in the liabilities side of the balance sheet. Whereas if money is borrowed by the company which needs to be paid back after 1 year, then this is known as long-term debt. This is shown under the long-term liabilities section in the liabilities side of the balance sheet. Companies take debt to grow their business or to invest in new projects. बहुत लोगों के अंदर एक परसेप्शन होता है कि डेप्ट बहुत खराब चीज है, डेप्ट नहीं लेना चाहिए, लेकिन ये बात सही नहीं है. अगर डेप्ट वाइजली लिया जाए तो ये कंपनी के ग्रोथ एंड एक्सपेंशन के लिए बहुत हेल्प करती है, लेकिन डेप्ट का लेवल थोड़ा रीजनेबल होना चाहिए. डेप्ट का लेवल अगर जरूरत से ज्यादा बढ़ जाए तो ये ऑब्वियसली रिस्की होता है. To judge whether the level of debt in a company's balance sheet is reasonable or not, we have to calculate certain financial ratios like debt equity ratio, interest coverage ratio, debt to cash flow ratio, etc. The short-term liabilities section of the balance sheet, if there is unearned revenues, then it's a good sign for the business. Unearned revenue, even though it's a liability, it's still a positive indicator for a business. It is the money a company has received as advance from customers before delivering the product or service. Even though unearned revenue is a liability, still not a scary one like loans or debt from the bank, because you don't have to pay back this money. You just need to deliver goods to the customer.
Assets are resources owned by a business that hold value. They are listed on the left hand side of the balance sheet, and it includes everything that the company owns like building, inventory, cash, short-term investments. The balance sheet of a company can be divided into two parts: current assets, which can be converted into cash within 1 year, as well as long-term assets, also known as non-current assets. These are resources owned by a company that are expected to provide economic benefits for more than 1 year. These assets are not intended for resale in the ordinary course of business, but are used in the operations of the company.
Long-term assets are those assets which are expected to give benefit to a company for more than 1 year. These are also known as fixed assets and include land and building, plant and machinery, furniture and fixture. Long-term assets are listed on the asset side of the balance sheet, separate from the current assets section. Short-term assets, also known as current assets, are the things that the company expects to use or convert into cash within 1 year. They are listed on the balance sheet of a company under the assets side. These assets are crucial for running a company's daily operations, and it provides insights into a company's ability to meet its short-term obligations. Examples of current assets include cash, inventory, short-term investments, prepaid assets, accounts receivable, etc. In the current asset side of the balance sheet, we have an item called inventory. Now, inventory refers to the company's products that the company is ready to sell, as well as the raw materials that are used to produce them. We should compare the growth rate of both these short-term and long-term assets with the growth in revenues over the last 5 years. And if over the last 5 years, the growth rate of short-term and long-term assets is more than the growth rate of revenues, then it means that the company is in a capital-intensive industry and it needs a lot of capital to grow, which can impact profitability. Loans and advances मतलब जब कंपनी का मैनेजमेंट डायरेक्टर्स या कंपनी एम्प्लॉइज को कंपनी की तरफ से अगर लोन मिले तो वो लोन्स एंड एडवांसेस सेक्शन में आएगा. तो वैसे अगर लोन्स एंड एडवांसेस बहुत ज्यादा हो गया मतलब कंपनी जो अपना बिजनेस में अपने प्लांट एंड मशीनरी वगैरह में इन्वेस्ट कर रही है, तो उससे ज़्यादा अगर लोन्स एंड एडवांसेस हो जाए, कंपनी अपने कोर बिजनेस में ध्यान नहीं दे रही है, तो वो कंपनी के फाइनेंशियल स्टेबिलिटी के लिए अच्छी बात नहीं है. As an investor, we must look closely at the quality of assets in the balance sheet to judge whether the company is stable or not. If the majority of assets are tied up in inventory or bills receivable, then it's a bad sign. But if there are lots of cash or investments in the balance sheet, then it means that the company is stable and financially healthy. Debt to equity ratio is a financial measure that compares how much a company owes as debt to how much money it has invested from its owners or shareholders. Basically, it's a way of measuring how much risk a company is taking on by borrowing money. If a company has very high debt to equity ratio, it means that the company is relying more on borrowed money to fund its operations. On the other hand, a lower debt to equity ratio means that the company is self-reliant on its own capital to fund its operations, which could be less risky. But the absolute level of debt to equity ratio would depend more upon the industry. Some capital intensive industries like infrastructure industry, real estate, capital goods industries, or manufacturing companies also, they require a lot of money to fund its operations. As such, these companies generally have a higher debt to equity ratio. But capital light industries like IT, consultancy companies or service-based companies generally have lower capital requirements. So these companies have a lower debt to equity ratio. The debt to cash flow ratio is another financial metric which shows how easily a company can pay off its debt by using its operating cash flow given in the cash flow statement. To calculate it, we have to divide debt given in the liabilities side of the balance sheet with the operating cash flow given in the cash flow statement. A higher ratio means that the company may struggle to pay off its debt. Generally, if the operating cash flow of a company is more than twice the amount of debt, then it's a good sign for a company. Other than this, we have to calculate an inventory turnover ratio also. Days inventory outstanding is a financial metric that measures the average number of days a company holds its product in its store or warehouse before selling it to the customer. To calculate inventory days, we typically divide the average inventory by cost of goods sold and then multiply the result by 365, as there are 365 days in a year. Lower inventory days can indicate a company is efficiently selling its product, while higher inventory days might suggest slow sales, potential obsolescence, or inefficiencies in
Debtor days is a financial metric that measures the average time a company takes to collect payments from its customers after a credit sale. Basically, it indicates how quickly a business is able to convert its sales into cash when goods are sold on credit. Ideally, the debtor days of a company should be within 30 to 40 days. But also it should be compared with the industry averages, and it should be lower than other companies in the same industry. Also, we should track the debtor days figure over the last few years and track whether the debtor days is rising or falling